All right, we've been going through a lot of adjusting entries. Now we're moving into the final stage in the accounting cycle. All right, what exactly is that accounting cycle? Again, I encourage you to pause the video and see if you can remember those steps. Of course, depending upon the textbook that you guys have or the professor or teacher that you have, they may be slightly different, but this is what we're working with here. Again, pause, see if you can recall on your own. All right, so transactions occur, they get journalized, and from the journal they are then posted into the ledger accounts. Then we have the adjusting entries, which is what we've been spending all of our time doing. A lot of time on the adjusting entries. One of the more complicating parts of the process, we create a trial balance, and from the trial balance we then create our financial statements. And now we've got our financial statements, we've got our balance sheet, our income statement, cash flow statements, whatever we need, and then we close the entries. Make sure you cannot close the accounts or you can't create the financial statements after the accounts are closed, because a lot of those temporary accounts just go away. They get basically put into our capital accounts, and that's what we're going to go through here today, is looking back at those closing entries. So of course then everything starts again, we open our books, and then the cycle begins again until we end up having to close the books. So what is it? Why is it that the accounts are closed after the financial statements are created? Well, it's a very simple answer. If we close them, we wouldn't know what our revenue and expenses are, because those would be set back to zero. And essentially, the income that is created and the expenses that are incurred are happening over a period of time. So we have to reset the period of time, and we have to have consistent time periods. And so we begin our lesson into closing entries. Well, what are they? Closing entries, they're at the end of the accounting cycle. All temporary accounts, meaning revenue, expense, and drawings, are closed, and the balances get reset to zero. Closing entries transfer temporary account balances to the owner's equity account. So we have to find out how much those things are worth. So we have revenue, minus expenses, minus drawings, and then whatever that difference is goes back into the owner's equity account. And this here is a temporary account, a storage place as we go through. So this is what we call income summary. Income summary is a temporary account used to close other temporary accounts before it is closed to the owner's equity account. So we use this as like a temporary storage bin before we're done with it. And there is an order to closing the accounts. First, we close revenue. We close the revenue accounts close to the income summary. Then we close the expense accounts to the income summary. If the income summary will either show a net income or net loss. So if our revenue accounts are more than our expense accounts, then it is a profit, a net income. And if our revenue accounts are less than our expenses, then it will be a net loss. And this is where it becomes a little bit more tricky. You have to pay attention to the overall amount. A lot of students will make a mistake on the third one, which is closing the income summary to the owner's equity. If you have a net income, then what ends up happening is, well, owner's equity increases on the credit side. So we would want to credit this, and that means we'd have to debit this if it's net income. And if this is a net loss, well, it's the opposite. Then we would be debiting owner's equity, and we'd be crediting our income summary. So that's ideally not the situation that we are in, but at the same time, we have to be cognizant of the fact that there could be a net loss. Drawings are closed to owner's equity account. This will decrease owner's equity. So this would be a debit for owner's equity and a credit to drawings. More efficient to close accounts using what we call compound entries. You can do them all at once, but we're going to be going in steps here. So here is our trial balance, and our job here is to journalize the closing entries. At this point, I would encourage you to pause and think about what exactly you're going to do. Firstly, which accounts are we closing? Well, it's going to be these temporary accounts down here. The service revenue, drawings, service revenue, advertising expense, utilities expense, and rent expense. And this is a very simplified version because I just want to show you the process. So the very first step is we're supposed to be closing out this revenue account. How do we do it? Well, we're going to close right now. This is what we call it's a credit balance. So how do we get rid of this? How do we set it back to zero? We are going to debit revenue, and we're going to credit our income summary. Let's take a look how that works out. So we only care about this part. These are our temporary accounts. We're going to close them out. So there's our service revenues get debited 40,000, our income summary gets credited 40,000. And look at this, we've got a little bit of a small summary or chunk of that down here. So now we have closed out our revenue accounts. What's next? Well, revenue's gone. Next on the chopping block here are the expenses. So we're going to have to figure out what these things are. These are currently debits, and we want to credit each account separately to set the balance to 0. So we will be crediting advertising expense 6,000, utilities expense 4,500, and a rent expense 24,000. And then these totals, if we're to add them all up, well, there's 10,500, there's 34,500. We would be taking that amount and we'd be putting it into the income summary as a debit. So here we go, 34,500, and here's our advertising expense, and as expected, these are in fact credited. So did we make money or did we lose money? Well, we can see here that our revenue was 40,000 and our expenses was 34,500. This matches our total expenses number. So we did in fact make money. So that tells you that right now the income summary has a credit balance and a difference of, well, what's 40,000 minus 34,500? Well, it'd be 5,500. So our net income is 5,500. And so we end up closing that amount into our capital dares account. So that's where we go. Income summary gets debited. Now again, be very careful and watch the balances to make sure and check if you're making money or you're losing money, because this third entry is a very common mistake where students will debit or credit the incorrect way. And finally, we have to close off our drawings account. Well, to try and decrease our capital, it is a debit, and our drawings gets closed out as 10,000, and that resets all of our temporary accounts back to 0. And that is it for closing accounts. Hopefully this is a good, nice, quick little review for you. If you ever have any questions, reach out to me. I'd be happy to help.